Thank you very much. It's a pleasure to be with you. Let me start by saying that while I've been a finance professor for the last 25 years, I have twice had the privilege to serve at the U.S. Department of Treasury, including most recently as the Deputy Secretary, the number 2 to Secretary Bessent last year. As this conference opened, the message that I would like to step back and convey to all of you is that the innovation on display at this conference is literally changing the world. While much of the next couple of days will focus on the incredible technological innovations that are underway, my goal is to articulate the economic use cases of this technology and how they have the potential to improve people's lives everywhere. I remind people regularly that billions of people on our planet still engage through commerce through the use of paper currency. Money can be lost, it can be stolen, it can be burned, but more importantly, is the frequency with which money is devalued through bad government policy. What the technology being showcased at this conference offers is the chance to bring modern financial services to the unbanked and the unbrokered. It means moving away from physical money to more secure ways of financially governing our lives. The ultimate goal being faster, cheaper, and safer ways of realizing commerce. For the last number of years, government policy in the United States hindered the development and deployment of digital assets. Fearful of the disruption that might occur and the challenges of the unknown, innovation in this space was ceded to other parts of the world. That changed in early 2025 with the inauguration of President Trump. He ordered an immediate, comprehensive report about the status and opportunities that exist in the digital asset space. We at Treasury led that work, working closely with the White House, the Congress, the Securities and Exchange Commission, and the Commodity Future Trading Commission. The actions taken in the last year demonstrate our commitment to upgrading the United States regulatory environment to harness the potential that technology futurists foresaw years ago. Last July, President Trump signed the Genius Act, the first major piece of legislation in the United States that addresses stablecoins. In my mind, the Genius Act reasserted U.S. leadership in the payment space and worked to further the dollar as the world's reserve currency. This legislation paved the way for industry to continue investing and innovating now that they know there is certainty in the legal environment. Why does all of this matter? Imagine what foreign remittances will look like if the world adopts stablecoins. No longer are we sending electronic messages on SWIFT representing a series of correspondent bank transactions being underway that will get money overseas in days. What the distributed ledger technology on a global blockchain offers is the settling of that same transaction in minutes at a fraction of the cost. When I first saw this technology 7 years ago when I was serving as the chief economist at the U.S. Treasury, I remember thinking that this is not the time to be Western Union. Imagine hastening payment clearance of international trade because cargo verification on a blockchain results in instantaneous payment for that cargo anywhere in the world. There is no reason for ships to sit idle while they wait payment while we have global deployment of modern payment systems that are safer and cheaper. Imagine setting up retail payment systems in countries where poverty and lack of infrastructure previously meant most of their citizens lacked access to a bank account and instead funded most of their purchases with cash. Rather than relying on cash in a non-existent banking system, transactions can now be carried out digitally on any number of devices. Today, the biggest competition banks face in many parts of the world are coming from cell phone companies. Indeed, in some countries, the banks are the cell phone companies. Likewise, imagine eliminating the mismanagement and corruption of some central banks whose gross negligence has resulted in runaway inflation that devalues the labor of workers in countless countries. Blockchain technology and digital assets, including stablecoins, enable customers and retailers to much more readily abandon failing local currencies for more stable global ones that better store value and better facilitate timely exchange. Historically, the lack of physical currency from more stable regimes has enabled countries to create a monopoly on how exchange takes place in their country, and their management of that currency locked people into failed payment systems. Moving to digital money eliminates local supply constraints and no longer means that people are confined to seeing the fruits of their labor squandered by rampant inflation caused by central bank mismanagement. Both consumers and retailers will willfully move to such a situation. This is the promise of digital assets and stablecoins. This is a glimpse of the future that guided my efforts to get to the Genius Act to the President's desk last July. What did that legislation do? First and foremost, our goal in the Genius Act is to generate confidence in digital money by generating the credibility of one-for-one exchange with physical currency. People will not adopt new technology unless they are convinced that they can always revert to something that they have trusted for decades. Even though the goal is to move away from physical money, it does need to continue to exist as people gain confidence in digital money. In the developed world, people still put their money in bank accounts and engage in the predominant form of their financial transactions through the bank accounts, but they always know that they have the option of reverting back to physical currency. That option is what provides faith in the banking system. We must do the same with stablecoins. That way, when we generate that confidence to put significant the way that we generate that confidence is by putting restrictions on what backs stablecoins so that a one-for-one exchange is maintained. Post-Genius, digital money must be backed by assets that cannot lose value. We therefore limited stablecoin reserve assets to very short-term U.S. Treasury securities, deposits at the Federal Reserve, other high-quality liquid assets, and deposits at insured institutions. These are securities that are backed by the U.S. government, so no matter what happens in the economy or the geopolitical world, the issuer's reserve assets can easily be converted into dollars at full value and ensure full redemption of the stablecoin. If we're going to offer substitutes for money, they need to have matching value to physical money at all points in time, no matter what happens. Second, we maintain privacy rights by ensuring that stablecoins and blockchains offered to U.S. citizens are done by private institutions who have the incentive to constantly upgrade the technology and the service that they offer. We banned central bank digital currencies. What that means is that before the government can see how a private individual in the United States uses their money, they would need to follow constitutionally mandated procedures for obtaining a warrant. The stablecoin account is not on a government ledger whose value can be blocked because a particular administration does not like who the depositor is or what legal industry they operate in. Under both the Obama and the Biden administrations, we saw companies in the cryptocurrency space, as well as individuals, be debanked for political reasons, and that is why there is enormous resistance in the United States to the creation of a CBDC. Instead, we legislated a private party stablecoin system with issuers that are regulated like banks. Third, we applied anti-money laundering standards to stablecoins. The global financial system has made extraordinary strides in the last few decades, reducing financial flows for illicit activities. None of us want to see vast expansion of terrorist arms sales, easy flow of money for drug smuggling, human trafficking, tax evasion, or other forms of illegal behavior. By making sure that every entry point into the financial system requires full identification, we are in a much better position to stop payments that go towards illicit behavior. Many leaders in the previous administration speculated that cryptocurrencies were solely a means to undo the progress that has been made on monitoring and prohibiting financial flows for illicit acts. In my view, a very small fraction of crypto transactions are done for nefarious purposes, but this technology will only receive widespread adoption that results in the betterment of the lives of billions if global governments trust that its usage is nearly entirely benevolent. For the developers in this room, please work with policymakers to implement safeguards against actors with ill intent. I know it hampers some of your work. I know it partially slows things down and raises cost. But you aren't looking to make it easier for cartels trafficking in human misery to profit off of that misery. Like me, you see the potential of digital assets to speed transaction clearance, lower costs, and enhance security. Policymakers are willing to work with you to make their requirements less onerous. But we cannot allow places like North Korea to fund their nuclear weapons program off of a legally obtained cryptocurrency. Finally, passing the Genius Act credibly conveyed that the United States once again seeks to lead the world in financial innovation. Gone are the days when we feared the displacement or creative destruction that might come with the technological breakthroughs that we are seeing here at this conference. Instead, we are embracing Web3 and the future of finance in order to maintain and enhance the dollar in facilitating global trade. We know that we only have a seat at the table to participate in international standard discussions if we are creating such standards at home. We know that the future global reserve currency is a digital one, and U.S. stablecoins are the means by which the U.S. not only retains its foundational reserve asset, but as Secretary Bessent has remarked, there are potentially trillions of dollars in additional demand for U.S. Treasury securities because of the adoption of U.S.-denominated stablecoins. Even with the progress we made last year, there is still much work to be done. While we succeeded in generating a consensus around stablecoins that resulted in the President signing the Genius Act last July, we have not extended that regulatory certainty into the rest of the digital asset ecosphere. The House of Representatives passed the Clarity Act last year, and the Senate continues to debate that act, and we're hopeful that it will get passed and sent to the President's desk for signature this year. Stablecoins enable potentially billions of unbanked around the world to move to more secure, faster, and cheaper retail transacting away from physical money. Clarity would bring that same access to the unbrokered. Again, imagine a world where more of our assets could be securitized or tokenized and traded. A world where exchanging those ownership stakes does not require a high-cost brokerage model, but instead were facilitated on blockchain technology. How many billions of people on our planet have been blocked from accessing investment vehicles that provide for the accumulation of wealth? Access to stock and bond markets should be democratized, and realizing opportunities of diversified wealth creation will unlock capital for innovators and facilitate saving and investment options that better smooth people's spending over their lifetimes. Secretary Bessent recently wrote an op-ed in the Wall Street Journal calling on the Senate to pass Clarity to do for the unbrokered what we did in Genius for the unbanked. Like with stablecoins, we do need to put in place rules on market structure, investor protection, and anti-money laundering provisions that retain the best parts of our existing financial architecture, but that lower cost while increasing speed and security. We're also making sure that our banking system works collaboratively with the digital asset space. Our banking agencies have removed so-called reputation risk as a means by which backward-looking regulators punish innovation in the digital asset space. Obviously, there are risks associated with this new technology, but we should not use our banking system for political reasons to go after lawful technologies that might be scary. Instead, we need to create the appropriate security guardrails and update our regulatory and supervisory processes for the current financial and technological environment. Our banking system also cannot thwart the evolution of payment systems as a way to protect their existing monopoly. It is true that we must fully understand the architecture of these new systems so that in times of macroeconomic stress, we know what to monitor and where the bottlenecks are located. But that does not mean blocking this technology. Competition is what realizes the best outcome for people, not out-of-date rules that protect incumbents. We cannot allow the fear of change to lock in outdated modalities while the rest of the world leaps into the financial future. When I was getting my PhD 25 years ago, nobody was doing research in the payment system. We thought we understood how banks operate and that the interesting parts of finance were topics like security interests, risk management, and how tax policy could encourage more investment. Today, there is no more exciting research in financial economics than the practical applications of the technological innovation being highlighted at this conference. Just as my fellow financial economists have had to learn more about technology to navigate the new financial world that futurists are creating, I implore the innovators and entrepreneurs gathered here to understand the economics and finance of what you are deploying. The technology is fascinating in and of itself, but to realize its full potential, we must always ask, what is the use case? What existing activity is being replaced? And what features of the existing regulatory structure will inevitably flow into the new architecture being created? Consumer protections are going to need to be retained. Transactor identity is essential to mitigate the use of this technology for criminal endeavors. User education will need to occur. And if this new technology becomes critical infrastructure, governments will insist on overseeing the systemic risk that such centrality may cause. Your work has certainly grabbed the attention of policymakers, and it is incumbent on us policymakers to work with you to facilitate your innovation and realize its potential. As I opened with, billions of people will likely benefit from this work. I ask for your assistance and your patience in educating us policymakers on the nuances of your technology. But at the same time, I implore you to educate yourselves on where this technology fits into the existing economy and why we therefore project the concerns onto this technology that we do. Working together, I see this technology and artificial intelligence as the most important innovations that we will be benefiting from over the next decade. Thank you for including me in your conference, and I look forward to meaningful dialogue over the next few years.